Exotic options. Exotic options are the class of option contracts with structure and features different from plain vanilla options, that is, American option style and European option styles. Not only that, exotic options are different from these vanilla options in their expiration dates also. As mentioned earlier, an American option allows the option buyer to exercise its right at any time on or before expiration date. On the other hand, European option can be exercised only at the expiry of maturity period. Exotic option is some type of hybrid of American option and European option and hence falls somewhere in between these options. Difference between exotic option and a traditional option. An exotic option can vary in terms of payoff and time of exercise. These options are more complex than vanilla options. Mostly, exotic options are traded in over-the-counter market. Types of exotic options. The most common types of exotic options are as follows. First one, chooser options. This option provides a right to the buyer of the option after a specified period of time to decide whether purchased option is a call option or put option. It is to be noted that the decision can be made within a specified period prior to the expiration of the contracts. Next, compound options, also called as split fee option or option on option. As the name suggests, this option provides a right or choice, not an obligation to buy another option at specific price on the expiry of first maturity date. Thus, it can be said in this option, the underlying is an option. Further, the payoff depends on the strike price of a second option. Third option is barrier options. Though it is similar to plain vanilla call and put options, but unique feature of this option is that contract will become activated only if the price of the underlying reaches a certain price during a period. Predetermined period. Next, binary options. Binary options, also known as digital option. This option contract guarantees the payoff based on the happening of a specific event. If the event has occurred, the payoff shall be pre-decided amount. The payoff shall be pre-decided amount, and if the event it has not occurred, then there will be no payoff. Next, Asian options. These are the option contracts whose payoff are determined by the average of the prices of the underlying over a predetermined period during the lifetime of the option. Next, Bermuda option. It is somewhat a compromise between European options and American options. Contrary to American option, where it can be exercised at any point of time, the exercise of this option is restricted to certain dates or on expiry like European option. Next, basket options. In this type of contracts, the value of option instead of one underlying depends upon the value of a portfolio, that is a basket. Generally, this value is computed based on the weighted average of underlying constituting the basket. Spread options. As the name suggests, the payoff of this type of options depends upon the difference between prices of two underlying. Look back options. Unlike other types of options whose excess price are pre-decided, this type of option, in this option on maturity date, the holder of the option is given a choice to choose a most favorable strike price depending on the minimum price and maximum price of an underlying achieved during the lifetime of option. So, types of exotic options, chooser options, compound options, barrier options, binary options, Asian options, Bermudian options, basket options, spread options, look back options. Next concept, credit derivatives. Credit derivatives is summation of two terms, credit derivatives. As we know that derivative implies value deriving from an underlying, and this underlying can be anything we discussed earlier, that is stock, share, currency, interest, etc. initially started in 1996 due to the need of the banking institutions to hedge their exposure of lending portfolios. Today, it is one of the popular structured financial products. Plainly speaking, the financial products are subjected to following two types of risks. First one, market risk. Second, credit risk. Market risk due to adverse movement of the stock market, interest rates, and future and foreign exchange rates. Credit risk, also called as counterparty or default risk. This risk involves non-fulfillment of obligation by the counterparty. While financial derivatives can be used to hedge the market risk, credit derivatives emerged out to mitigate the credit risk. Accordingly, the credit derivative is a mechanism whereby the risk is transferred from a risk-averse investor to those who wish to assume the risk. Although there are a number of credit derivative products, but in this chapter we will discuss two types of derivatives: collateralized debt obligation and credit default swap. First one, collateralized debt obligations, CDOS. While in securitization, the securities issued by SPV are backed by the loans and receivables. The CDOs are backed by pool of bonds, asset-backed securities, REITs, and other CDOs. Accordingly, it covers both collateralized bond obligations (CBOs) and collateralized loan obligations (CLOs). Types of CDOs. Various types of CDOs are as follows: cash flow CDOs, synthetic collateralized debt obligations, synthetic CDOs, and arbitrage CDOs. Cash flow, synthetic, and arbitrage. First one, cash flow CDOs, cash flow collateralized debt obligations. Cash CDO is CDO which is backed by cash market debt or securities which normally have low risk weight. This structure mainly relies on the collateral's risk weight and collateral's ability to generate sufficient cash to pay off the securities issued by SPV. Second, synthetic collateralized debt obligations, that is synthetic CDOs. It is similar to cash flow CDOs, but with the difference that instead of transferring ownership of collaterals to SPV, a separate legal entity, synthetic CDOs are structured in such a manner that credit risk is transferred by the originator without actual transfer of assets. Normally, the structure resembles the hedge funds, wherein the value of portfolio of CDO is dependent upon the value of collateralized instruments, and market value of CDOs depends on the portfolio manager's ability to generate adequate cash and meeting the cash flow obligations, principal and interest, in timely manner. While in cash CDOs, the collateral assets are moved away from balance sheet. In synthetic CDOs, there is no actual transfer of assets. Instead, economic effect is transferred. This effect of transfer economic risk is achieved by creating provision for credit default swaps (CDS) or by issue of credit-linked notes (CLN), a form of liability. Accordingly, this structure is mainly used to hedge the risk rather than balance sheet funding. Further, for banks, this structure also allows the customers' relations to be unaffected. This was started mainly by banks who want to hedge their credit risk but not interested in taking administrative burden of sale of assets through securitization. Technically speaking, synthetic CDOs obtain regulatory capital relief benefits vis-a-vis cash CDOs. Further, there are more popular they are more popular in European markets due to the reason of less legal documentation requirements. Synthetic CDOs can also be categorized as follows: unfunded, fully funded, partially funded. Unfunded, it will be comprised only CDs. It will be comprised only CDs. Next, fully funded, it will be through issue of credit linked notes. Partially funded, it will be partially through issue of credit linked notes and partially through CDs. that is commercial deposits. CDs, collateralized debts. Next, arbitrage CDOs. Basically, in arbitrage CDOs, the issuer captures the spread between the written realized collateral underlying the CDOs and the cost of borrowing to purchase these collaterals. In addition to this, issuer also collects the fees for the management of the CDOs. This arbitrage arises due to acquisition of relatively high yielding securities with large spread from open market. Risks involved in CDOs. CDOs are structured products and just like other financial products are also subject to various types of risks. The main types of risks associated with investment in CDOs are as follows. First one, default risk. Second, interest rate risk. Third, liquidity risk. Fourth, prepayment risk. Fifth, reinvestment risk. Sixth, foreign exchange risk. First one, default risk. It is also called as credit risk. It emanates from the default of underlying party to the instruments. The prime sufferers of these types of risks are equity or a junior trench in the waterfall. Next, interest rate risk, also called as basis risk, and mainly arises due to different bases of interest rates. For example, asset may be based on floating interest rate, but the liability may be based on fixed interest rate. Though this type of risk is quite difficult to manage fully, but commonly used techniques such as swaps, caps, floors, collars, etc. can be used to mitigate the interest rate risk. Next, liquidity risk. Another major type of risk by which CDOs are affected is liquidity risks, as there may be mismatch in coupon receipts and payments. Next, prepayment risk. This risk results from unscheduled or unexpected repayment of principal amount underlying the security. Generally, this risk arises in case assets are subject to fixed rate of interest and debtors have a call option. Since in case of falling interest rates, they may pay back the money. Reinvestment risk. This risk is generic in nature and the CDO manager may not find adequate opportunity to reinvest the proceeds when allowed for substitutions. Foreign exchange risk. Sometimes CDOs are comprised of debts and loans from the countries other than the country of issue. In such a case, in addition to above mentioned risks, CDOs are also subject to foreign exchange rate risk. Next, credit default swaps, CDS. It is the combination of following three words: credit, default, swap. Credit means loan given, default means non-payment, swap means exchange of liability or risk. Accordingly, CDS can be defined as an insurance, not in stricter sense, against the risk of default on a debt, which may be debentures, bonds, etc. Under this arrangement, one party, called buyer, needing protection against the default, pays a periodic premium to another party, called seller, who in turn assumes the default risk. Hence, in case default takes place, then there will be settlement, and in case no default takes place, no cash flow will accrue to the buyer. A like option contract, an agreement is terminated. Although it resembles the options, but since element of choice is not there, it more resembles the swap arrangements. Amount of premium mainly depends upon the price of underlying and is especially when the credit risk is more. Main features of credit default swaps. CDS, credit default swaps. Main features. CDS is a non-standardized private contract between the buyer and the seller. Therefore, it is covered in the category of forward contracts. They are normally not traded on any exchange and hence remains free from the regulation of governing body. The International Swap and Derivative Association ISCD publishes the guidelines and general rules used normally to carry out CDS contracts. CDS can be purchased from third party to protect itself from default of borrowers. Similarly, an individual investor who is buying bonds from a company can purchase CDS to protect his investment from insolvency of that company. Thus, this increases the level of confidence of investors in bonds purchased. The cost or premium of CDS has a positive relationship with risks attached with loans. Therefore, higher the risks attached to bonds or loans, higher will be the premium or cost of CDS. If an investor buys a CDS without being exposed to credit risk of the underlying bond issuer, it is called NACD CDS. Uses of credit default swaps. Following are the main purposes for which CDS can be used. First one, hedging. Next, arbitrage. Next, speculation. Hedging. Main purpose of using CDS is to neutralize or reduce the risk to which CDS is exposed to. Thus, by buying CDS, a risk can be passed on to CDS seller or writer. Next, arbitrage. It involves buying a CDS and entering into an asset swap. For example, a fixed coupon payment of a bond is swapped against a floating interest stream. Next, speculation. CDS can also be used to make profit by exploiting price changes. For example, a CDS writer assumes assumed risk of default will gain from contract if credit risk do not materialize during the tenure of contract or if compensation received exceeds potential payout. Parties to CDS. In CDS, at least three parties are involved, which are as follows. First one, initial buyers. Second, buyer. Next, seller. Initial borrowers, buyer, seller. Three parties to CDS. Initial borrowers, buyer, seller. Initial borrowers. It is also called as a reference entity, which are owning a loan or bond obligation. Buyer. It is also called as investor, that is the buyer of protection. The buyer will make regular payment to the seller for the protection from default or credit event of reference entity. Seller, it is also called as writer of the CDS and makes payment to the buyer in the event of credit event credit event of a reference entity. It receives a regular payoff from the buyer of CDS. Example, suppose BB Corporation buys CDS from SS Bank for the bonds amounting to 10 million US dollars of Danger Corporation. In such case, the BB Corporation will become the buyer, SS Bank will become the seller, and Danger Corporation will become the reference entity. BB Corporation will make a regular payment to SS Bank of the premium, and if Danger Corporation defaults on its debts, the BB Corporation will receive one-time payment and CDS contracts is terminated. Settlement of CDS. Broadly, following are main ways of settlement of CDS. First one, physical settlement. Second, cash settlement. Physical settlement. This is the traditional method of settlement. It involves delivery of the bonds or debts of the reference entity by the buyer to the seller, and seller pays the buyer the par value. For example, as mentioned above, suppose Danger Corporation defaults, then SS Bank will pay 10 million US dollars to BB Corporation, and BB Corporation will deliver 10 million face value of bonds to SS Bank. Second, cash settlement. Under this arrangement, seller pays the buyer the difference between par value and the market value of the debt, whatever may be the market value of the reference entity. Continuing the above example, suppose the market value of the bonds is 30%, as market is of belief that bondholder will receive 30% of the money owed in case company goes into liquidation. Thus, the SS Bank shall pay BB Corporation 10 million US dollars minus 3 million US dollars, that is 7 million. How to calculate 3 million? That is 30% of 10 million. Next, to make cash settlement even more transparent, the credit event auction was developed. Credit event auction set a price for all market participants that choose to cash settlement. Next concept, weather derivatives. While there are some companies whose performance are completely affected by weather, but there are many companies whose performance is liable to be adversely affected by the weather. For example, airline companies, juice manufacturing companies, etc. Especially farmers are highly exposed to weather. To hedge this risk, instruments are required like instruments instruments are used to hedge foreign exchange and other financial risks. This led to a rise of a new class of financial instruments, weather derivatives, has been introduced to enable businesses to manage their volumetric risk resulting from unfavorable weather patterns, just as traditional contingent claims whose payoffs depends upon the price of some fundamental. A weather derivative has its underlying asset, a weather measure. Weather, of course, has several dimensions: rainfall, temperature, humidity, wind speed, etc. There is a fundamental difference between weather and traditional derivative contracts concerning the hedge objective. The underlying of weather derivatives is represented by a weather measure which influences the trading volume of goods. This in turn means that the primary objective of weather derivatives is to hedge volume risk rather than price risk that results from a change in the demand for goods due to change in weather. The first weather transaction was executed in 1997 in the over-the-counter market by Aquila Energy Company. The market was jump-started during the warm Midwest or Northeast EI Nino winter of El Nino winter of 1997 and 1998, when the unusual higher temperatures induced companies to protect themselves from significant earnings declines. Since then, the market has rapidly expanded. Weather derivatives represent an alternative tool to the usual insurance contracts by which firms and individuals can protect themselves against losing out because of unforeseen weather events. Many factors differentiate weather derivatives from insurance contracts. The main difference is due to the type of coverage provided by the two instruments. Insurance provides protection to extreme low probability weather events such as earthquakes, hurricanes, and floods, etc. Instead, derivatives can also be used to protect the holders from all types of risks, including uncertainty in normal conditions that are much more likely to occur. This is very important for industries closely related to the weather conditions, for which less dramatic events can also generate huge losses. Like other derivatives, a weather derivative is a contract between a buyer and a seller wherein the seller of a weather derivative receives a premium from a buyer with the understanding that the seller will provide a monetary amount in case the buyer suffers any financial loss due to adverse weather conditions. In case no adverse weather conditions occurs, then the seller makes a profit through the premium received. Pricing a weather derivative is quite challenging as it cannot be stored, and following issues are involved. First one, data. Second, forecasting of weather. Third, temperature modeling. First, data. The reliability of data is a big challenge as the availability of data quite differs from one country to another and even agency to agency within a country. Forecasting of weather. Though various models can be used to make short term and long term predictions about evolving weather conditions, but it is difficult to predict the future weather behavior as it is governed by various dynamic factors. Generally, forecasts address seasonal levels but not the daily levels of temperatures. Next, temperature modeling. Temperature is one of the important underlying for weather derivatives. The temperature normally remains quite constant across different months in an year. Hence, there is no such model that can claim perfection and universality. Next concept, electricity derivatives. The purchase and sale of power in India takes place through state owned distribution companies which enter into power purchase agreements with power generators. Such long term contracts, usually 20 years, 30 years, are needed given the high capital and operational expenditure requirements of these projects. Since electricity spot prices in India are generally volatile due to smaller market size and various dynamic factors and other various dynamic factors such as change in fuel supply positions, weather conditions, transmission congestion, variation in RE generation, and other physical attributes of production and distribution, there is a need for hedging instruments that reduces price risk exposures for market participants, that is, generators, buyers, and load serving entities. As discussed earlier, the derivative instruments can be used to hedge the risk of price volatility. Derivative contracts linked with spot electricity prices as underlying can help market participants to hedge from price risk variations. This will help the buyer to pay a fixed price irrespective of the variation in spot electricity prices as variations are observed by derivative instruments. Like other derivatives, the vanilla form of electricity derivatives are forwards, futures, and swaps. Not only that, being traded either on the exchanges or over the counters, these power contracts play the primary role in offering future price discovery and price certainty to generators, distributing companies, and other buyers. First, electricity forwards. Electricity forward contract represent the obligation to buy or sell a fixed amount of electricity at a pre-specified contract price known as forward price at a certain time in the future called maturity or expiration time. Like financial and commodity forward contracts, electricity forwards are custom tailored supply contracts between buyer and the seller where the buyer is obligated to take power and the seller is obligated to supply. The payoff of a forward contract promising to deliver 1 unit of electricity at price F at a future time T is payoff of the forward contract, that is ST minus F, where ST is the electricity spot price at time T. Although the payoff function appears to be similar as payoff in case of a financial forwards, electricity forwards differ from other financial and commodity forward contracts in the sense that the underlying electricity is a different commodity at different times. The settlement price ST is usually calculated based on the average price of the electricity over the delivery period at the maturity date T. Next, electricity futures. Electricity futures are contracts for the delivery of certain quantity of electricity at a specified price and a specified time in future. Sellers can sell a proposition of their production in the future market, while consumers can buy a specified amount of the power they need. Like other financial future contracts, electricity future contracts are standardized contracts in terms of trading locations, transaction requirements, and settlement procedures. The apparent difference between the specifications of electricity futures and those of forwards is the quantity of the power to be delivered. The delivery quantity specified in electricity future contracts is often significantly smaller than in forward contracts. Like difference between financial futures and forwards discussed earlier, the electricity futures are exclusively traded on the organized exchanges and electricity forwards are usually traded over the counter. As a result, the electricity future prices are more transparent than forward prices, being reflective of higher market consensus. Similar to financial futures, most electricity future contracts are settled by financial payments rather than physical delivery, resulting in lowering of the transaction costs. In addition, credit risks and monitoring costs in trading futures are much lower than those in trading forwards, since exchanges implement strict margin requirements to ensure that financial performance of all trading parties. The fact that gains and losses of electricity futures are paid out daily as opposed to forward contract being accumulated and paid out in a lump sum at maturity time thus reduces the credit risks. Overall, as compared to electricity forwards, the advantages of electricity futures lie in market consensus, price transparency, trading liquidity, and reduced transaction and monitoring cost, though there are limitations of various basis risks associated with the rigidity in futures specifications and the limited transaction quantities specified in the contracts. Last, electricity swaps. Electricity swaps are financial contracts that enables their holders to pay a fixed price for underlying electricity regardless of the floating electricity price or vice versa over the contracted time. They are typically established for a fixed quantity of power reference to a variable spot price at either a generator's or consumer's location. Electricity swaps are widely used in providing short to medium term price certainty for up to a couple of years. Similar to similar to financial swaps, electricity swaps can be considered as a strip of electricity forwards with multiple settlement dates and identical forward prices for each settlement. Another variant of electricity swap is electricity location basis swaps, wherein a holder of an electricity swap agrees to either pay or receive the difference between a specified futures contract price and another locational spot price of interest for a fixed contract cash flow at the time of the transaction. These swaps are used to lock in a fixed price at a geographic location that is different from the delivery point of futures contract and hence are effective financial instruments for hedging the risk based on the price difference between power prices at two different physical locations. Derivative mishaps and lessons. Lessons from derivative mishaps. Don't buy any derivative product that you don't understand. Due diligence before making Treasury Department as profit center. Specify the risk limits. Separation of front, middle, and back offices. Ensure that a hedger should not become a speculator. Carry out stress test scenario analysis.